Okay, I'm going to kick it off. I know we'll still have a few folks filter in, but hopefully they don't miss too much. So today's webinar is titled Staying Ahead in a High Inflation Era. And this is strategies for actuaries and data scientists in insurance. So this is a production of Accurate Academy. This is the thought leadership arm of Accurate. And a brief reminder, today's webinar will be recorded. So you should have had the option to accept that when you join the Zoom call. And you'll be privileged to a copy of the recording after we've done the post-processing. And you should get that as a link in your email. So with that, let's kick it off. So briefly, I'll introduce myself. My name is Max Martinelli. We have a lot of material to cover, so I'm not going to go into all this, but I'm an actuarial data scientist here at Accurate. I've been here for a few months. Before this, I've had a career of about 8 years in P&C insurance and various actuarial and data science roles. My background is like high frequency telematics, homeowners insurance, mostly personal lines. So with that, before we get started, I have a quick ask, and this is unrelated to the webinar. But I used to go to actuarial clubs and data science clubs and promote the actuarial profession here in the United States. And when I joined Accurate, they have continued to support me with that. And the reason I bring this up is because, back in the day, the questions that I used to get asked were more about, the exam process or work-life balance or what do actuaries do. I took a break during the pandemic, and then I started again last semester. I did my first one since then. And it was really interesting because questions totally changed. The questions were now more about, should I be an actuary or should I be a data scientist? What about machine learning, R or Python? And it showed me that these young folks, the allure of some of the more tech-heavy fields have got their attention, and they're debating, should I go into actuarial science or should I go into machine learning? And I'd like to think that the actuarial profession still offers them a lot of opportunity because there is a very advanced side to the actuarial discipline, but they also have that room to grow into other branches of it. And you get the stability of this field, the wisdom of a very old discipline. So I would like to continue doing this and maybe not persuade them to join, but give them all the resources they need to make that decision for themselves. So the ask is, if you're willing to share a 30-second video, I would cap it at 30 seconds because the attention spans aren't what they used to be. But just anything that you would tell someone at that age. And you don't have to be on the data science side of the field. I think it's good for them to see a diversity of viewpoints. But if you're interested in that, shoot me a message on LinkedIn. It would be greatly appreciated. So with that, let's get into today's topic. So pricing in an age of high inflation. So here's the background. Accurate typically proliferates a lot of machine learning knowledge in the actuarial field, but more recently we put out a white paper, and specifically it was my colleague Edwin Graham and one of our partners at FCG, Alexander Erickson. They put out a nice, brief 8-page white paper. And the reason I mentioned the length is because I think Accurate has a reputation of putting out these very long white papers, maybe pushing the definition of white paper. We recently put out one that was, over 100 pages. So this one is a little bit truer to that definition. And what I liked about it is, a very nice, easy read. And it was great because it's something that, we have so many stakeholders and people that are downstream from our work in the actuarial profession. When I was reading this, I thought this is a great resource that if I was still in an insurance company, I would share this with my stakeholders. So this is a great thing to just pass to them and say, hey, this is how things are changing. These are some of the strategies we're looking at. And maybe we can start discussing how the deliverables will change. So it's a nice, easy read, and definitely recommend checking that out. But this would be a pretty boring webinar if I spoke for an hour about an 8-page webinar. So this content tends to build on top of that and be a little bit more exploratory. I not only wanted to talk about the strategies, but maybe some of the edge cases where those strategies might not pick up on it. So I definitely encourage you to check out the white paper. It's a good read. We will go beyond it in this presentation. Objectives. No presentation would be complete without an agenda or some objectives. So I got a few here. Review inflation and some of the complications associated with it. Now, a bit of a heads up. I gave this as a rehearsal to a few peers, and they said, some of this introductory material was a bit boring, and we want to make an engaging, entertaining webinar that gives you all the information you need, but I do need to level set a bit. So I've tried to spice it up and move some of the later content in here, but to be fair, some of the juicy material is towards the end. Next, we want to discuss those strategies. So those 5 strategies that we have in this white paper, how can we use those to stay ahead of inflation and price volatility? Next is demonstrate that inflation impacts more than just the base rate and claim severity. There's a very obvious relationship between inflation and the base rate severity, but there's some more nebulous interactions between inflation and things like frequency or the rating variables that we'd like to discuss. finally, maybe this is a bit ambitious, but spark intrigue so viewers leave the presentations with more questions than answers. So typically we're giving these machine learning presentations and we're giving you a lot of information. Here it's more to just get your mind thinking about what's next and how can we stay on top of it. And we do have a ton of material in this presentation. When I first did it, it was about an hour and a half. We had to cut some stuff out, make it a little more condensed. So I'm going to talk fast, but the reason I mention that is, if you shoot questions into the Q&A, we might not have a ton of time to get to them, but I believe I can export a list of those and try and respond to them later. And I don't profess to be a macro economist who has all the answers on this. So I'll do my best, but feel free to shoot those questions. We just might not get to them today. Before we get started, a little bit of hedging our bets. So I've got a quote here from Peter Thiel. He's an American investor, kind of controversial guy. And my German counterpart was, a bit displeased that I didn't have a proper European philosopher. So forgive me. I'm based in the US and I know Peter Thiel, but the quote is, "The only thing about the future we know is that it's going to be different and it must be rooted in today's world." And here's the point I'm getting at. We don't know if inflation is going to subside. It definitely has been going that direction. Will it persist? Will it go back to the old normal? We don't know. So the title of this presentation may age poorly, but I don't think the content will be. So, feel free to shoot me a message in 2 years and say, hey, inflation's gone. The name of that webinar was bad, but hopefully you'll agree that content is still going to be relevant. So with that, let's get into inflation. Again, this is some of the level settings, so bear with me here, but I think we build on this pretty well. What is inflation? Everyone's favorite way to kick off a webinar with a definition. So I apologize, but we're mostly going to be poking holes at this in subsequent slides. So the standard simple definition is the rising price of goods and services. It's a more colloquial definition of too much money chasing too few goods. And what both of these definitions are getting at is there's some element of price which describes the relationship of units of compensation and units of goods and services in exchange for that. And when the derivative of price with respect to time is greater than zero, we call that inflation. When it's less than zero, we call that deflation. We would differentiate this though from periods of like price shocks where, one day you wake up, the price goes up, but a few days later it goes back down. So inflation tends to describe something that's more persistent or sticky than a price shock. So, that definition is great and it's useful, but it's not always clear if something is inflation. And so here I've got an example. This was an article that was in the news recently where this sedan rear-ended a Rivian. I don't actually know if this is the true picture from the claim, but illustrates what happened. And if you're not familiar with Rivian, it's an electric vehicle manufacturer in the US. They make high-end luxury pickups that are electric, and they started off a little slow, but they're becoming more popular. And so the insurance company for this sedan had sent the Rivian owner a check for $1,600 because that's what they estimated the repair to cost. Still maybe a little light, but it turned out to cost $42,000. And this almost capped out that the limit for this sedan. Now, there's nothing nefarious going on here. The mechanics followed the book on how Rivian says to take apart the vehicle, assess the damage, replace the parts. It's just a very complex vehicle that requires a lot more intricacy in assessing damage. And the question here is is this inflation? It depends on how you define it. So it's a bit more complex, but from the perspective of the pricing actuary, how would you even account for this, right? Because you're pricing the insurance from the perspective of this sedan. And so, obviously this would go in the base rate probably and the severity trends, but eventually maybe the geo variables pick up on the density of these vehicles in an area where someone's driving, but this is a really tricky thing to measure. So even if you employ these strategies, it's a bit nebulous of how you account for everything. So where I'm going with this is that those simple definitions are great. It's just more complex than that. And this is a very text-heavy slide. We're not going to go through all of it. The point I'm trying to get at here is there's lots of macroeconomic perspectives that seek to explain what inflation is. And this is just a short list. There's probably hundreds. And there's a few I want to point out that kind of show the gaps in those definitions. So the Austrian School of Economics, and so this is probably more popular in America these days. It's often described as fringe, maybe not the most mainstream, but these are the hard money folks. And so they tend to emphasize the supply of money being a driver of inflation. So if you increase the money supply, that drives inflation, and it's less about the supply and demand of goods. Now, some prominent Austrian economists predicted after the 2008 financial crisis that all the money printing was going to create runaway inflation, and it didn't. And some thought that disproved the Austrian school of thought. But to be fair, a lot of that money printing was in the form of bank reserves and didn't hit the broader money supply. So they had a moment of redemption after the COVID-19 pandemic, where there was a lot of money printing that did hit the broader money supply. And even after the supply chain constraints subsided, this inflation persisted. Now, we'll never know what the true causal relationship was, and that's a theme throughout this whole presentation of there might be a link to something. Can we establish causality? Who knows? The point with this perspective is that there's some element of the money supply at play here. There's some more recent perspectives that focus on expectations and behaviors. And this is why central banks tend to release their inflation targets, because they're trying to almost create like a self-fulfilling prophecy where if you think prices are going to go up 2% because of their strategies, maybe you'll raise your prices 2% to stay afloat. And it almost creates that feedback loop of a self-fulfilling prophecy. The next I would point out is the social perspective, which is that there's a relationship to interest rates. And so, the idea that there's a transfer of wealth from savers to borrowers during periods of inflation. Now, the point being here that there is a very clear relationship between interest rates and inflation. They're not always, 1-to-1, but this is why central banks will increase rates to try and quell inflation. And when you're calculating your real interest rate, you often use the interest rate and the level of inflation as an input. Now, for pricing actuaries, this tends to impact our folks more, our friends in reserving and valuation more than us. The point I'm trying to get at here is, there's lots of elements that are not picked up in those simple definitions: the money supply, behaviors and expectations, and interest rates. My prescription would be, embrace the fuzziness. Economics is a very complex, chaotic, dynamic system, and it's not the role of the actuary to figure this out. We'll let the macroeconomists debate this. And to the extent that something's useful, let's use it. Otherwise, let's not. I'm guessing in 1,000 years, our species will have a much better way to compute and model these things. But right now, let's just stay out of that and take what's useful. Okay, so I got a few text-heavy slides. Again, I'm going to build up to something here. But this slide, I think, is very relevant to actuaries because we tend to see this in our work as well. So when we're talking about trends, we tend to see these temporal dynamics, and it's very similar to inflation. So first off, there are cyclical components to inflation. And that tends to be described as like the business cycle. The boom and bust of businesses tends to drive inflation and deflation. And in insurance, we're typically on the other end of that. Inflation is thought to drive the underwriting cycle, but nonetheless, there's a cyclical component to this. Next, we have secular inflation. So these are long-term trends that typically play out over the course of decades. And they're structural factors such as technological advancement, trade, demographic changes, long-term government policy. And next is one-time shocks. So again, this is not to be confused with a price shock where the price goes up one day and then it comes back down. It's more that we wake up one day and the price is just elevated. And so, Russia invades Ukraine and the price of grain goes up. So the question is, which of these best describes what happened following COVID-19? You could probably say with some level of certainty that all of those were present. So these things can be competing with each other at the same time, and it's kind of hard to dissect. Another block heavy slide, so forgive me, but what are the types of inflation? So demand pull inflation, this is the one I think most people are familiar with, where if there's a snowstorm and the hardware store only has 12 shovels, price is probably going to skyrocket or they're going to sell all the shovels pretty quickly. So it's the supply and demand of goods driving this. Cost push inflation. So this is the idea that if the government imposes taxes or fees, those will get passed directly to consumers and raise the price. Built-in inflation. So this goes more to that expectation, that behavioral component where maybe we expect a cost of living adjustment at the end of the year for the inflation that took place, and that in itself might drive inflation. Hyperinflation. Unfortunately, our friends in Venezuela have experienced this, but this is typically a currency-related phenomenon. So there's an issue with the local currency compared to the currency its trade is denominated in. And lastly, a common one is stagflation. And this is maybe the first derivative of price is greater than zero, but the second derivative is flat. And so it's like a period of elevated inflation. Some are professing, we might experience this now as it happened in the 70s. Who knows, right? We don't know, but it's plausible. Okay, so how do you measure this? And this is where I think it starts to get good. So again, stick with me here. There's some traditional measures of inflation, and hopefully most people have heard of these, but for example, I've got core here. And so, there's typically consumer price indices. They measure a basket of goods and services over time, and we're trying to measure, how things go up. But core inflation will remove things like energy, and food, because there tends to be some volatility in those. Now you put these all together and you do get that consumer price index, but we can break these out and try to measure them separately. And additionally, some folks will look at wage inflation. And so this is just specifically how our salaries increasing. And the fear here is that maybe you have a wage spiral that drives inflation, and it's the cyclical nature that just keeps feeding on itself. So these are great, and I've used things like these before. And for example, when I was a state analyst, I used to put medical inflation trends on my claim severity charts, and it didn't always match up. But the hope was that medical inflation is probably a component of the severity, and maybe if we back it out, we can pick up on the other elements. But our friend Dave Clark over at Munich Re, who is a great person to follow on LinkedIn, I highly recommend it. He's always posting stuff that slips by me. But he posted a CNBC article recently that kind of talked about the quirks of these. And, the reader, it's not necessarily specifically for actuaries and the implications for them, but as you're reading it, you can start to see how this type of thinking can be a little tricky to incorporate into our work. So I just, for the sake of time, I don't have time to fully talk through it, but I encourage you to go check out the post that he has where he links to this. And so where I'm going with this is that there's a American investor, again, another American, so forgive me to the Europeans on the call, but his name is Kyle Bass. And Kyle Bass's claim to fame is that he was one of the folks who saw the 2008 financial crisis coming, and he made a lot of money from it. And he's kind of like an outspoken contrarian. And he's been in the news within the past year or so because he's been very vocal about how the American agencies calculate some of these inflation measures, in contrast to maybe like a German agency. So the German agencies tend to be a little bit more truer to how things are going throughout the course of their price evolution, but the American agencies tend to make a lot of adjustments. And his claim was that there's something nefarious going on. I don't know if that's the case, but he was specifically talking about this concept of chain weighting. And I'm not an expert on this, so I encourage you to go look this up. But the idea here is that if car vehicles have these roll down windows, and then all of a sudden we put automatic electric windows in cars, and that becomes standard, maybe that increased the price, but there was some sort of technological advancement where these things aren't on the same basis. And so his critique is that the Federal Reserve and the Bureau of Labor Statistics make all these adjustments that don't really reflect how things are changing. Now, from the actuarial perspective, I might be a bit sympathetic to those adjustments because we make adjustments all the time. But to be fair, our adjustments tend to be prospective and forward-looking, where these are retrospective. So you can already see where there might be a mismatch with some of these measures. There's some newer inflation concepts, and one is asset inflation. So this has always been around. The gold bugs, the hard money folks, believe in this. But the idea was that maybe financial instruments and real assets, which are not necessarily goods and services, maybe they increase in price. And we saw this phenomena after 2008, particularly in the United States of America, where all those bank reserves that we created a lot of financial stability. People thought maybe the Fed will just bail out markets forever, and financial assets and real estate had a total recovery and great decade of growth. So, this is an idea that, again, it's not necessarily goods and services, it's financial instruments. Dr. Pippa Malmgren, again, another person who I highly recommend you check out, but she coined this term shrinkflation many years ago. And this is the idea that maybe the Hershey's bar stays the same price, but it gets a little smaller. So, you're getting less goods as opposed to the price changing. Skimflation. We have a public radio station in the United States, and they have a program called Planet Money, and they were talking about skimflation, which is the idea of like maybe the quality of the good or service degrades. So the price doesn't change, the volume of it doesn't change, but it's just a lower quality product. And then I've got one called weightflation here. I don't know if this is a real term, but the idea that maybe the transaction isn't as instantaneous as it used to be. And there's a bunch of other ones on here. We're not going to go into it, but the question is, how does this impact actuaries? And I've got two examples for you. So I've got a bunch of friends and colleagues that know mill workers, cabinet makers, and one of their main inputs is plywood. And so as we saw within the past few years, the price of lumber went up. That's an input to plywood. So the price of a sheet of plywood went way up. But another thing that we saw was that lower quality plywood tends to have these gaps in them, but they are usually working with higher quality plywood. And what they were claiming is that the sheets of goods that they were buying that used to be totally free of these now had a lot of them in there. So the quality was degrading. On top of that, you used to be able to order a pallet of plywood and it would come the next day, and now they were waiting 3 months. This subsided, but then, Russia invaded Ukraine and there were sanctions on Russian exports. And guess what? Most sheets of plywood have a Baltic birch core. The Baltic birch comes from the Baltic region. So, this created huge delays. So they've just been hit with, triple whammies for years now. And you can easily see how this might go into pricing, right? If you are your customer as a claim and plywood as an input, it's now costing way more than it used to. The quality is degraded and it's taking longer to resolve their claim. So maybe they have to stay at a hotel longer. Additionally, we had examples with vehicles in the United States, and I'm not sure if this was as prevalent outside of the US, but due to all the supply chain constraints, accidents were taking place and it was harder to repair those vehicles because you just had to order the parts and they were taking longer. So now you're paying for someone to rent a vehicle for a longer period of time, but not just that, there was a vehicle shortage and the price of rental vehicles was going up. So it was a double whammy. So these types of things clearly can trickle into actuarial work and are a little bit harder to dissect. Okay, so hedging our bets again a little bit here, but don't rule out deflation. And so this chart is from Bloomberg, and it's showing the intentions of central banks in various countries, whether they intend to raise rates, lower rates, and it's actually a bit dated because the Federal Reserve here in the United States of America raised rates recently. The ECB raised them today, but both of them signaled that they could continue that. So I don't think the color coding's off. Now, just because some central banks are signaling that they might lower rates doesn't necessarily imply deflation, because there's a few components of rates, which is the inflationary component, but also the economic component. So maybe you want to stimulate your economy with lower rates and you'll just deal with some of the inflation. But there are macroeconomists out there, they tend to be in the minority, who are saying that there's structural deflation at play despite what we've seen. And so as the money that we created works its way through the economy, as the supply chain constraints continue to ease, we should see deflation. I don't know, I'm not professing to claim this, but you could already see how pricing across different territories with some of the things we've already discussed about could be difficult if you're using these public measures of inflation. And to that point, there's some that claim that deflation has been the underlying theme of humanity. Now, we haven't really seen that in our lifetimes. Maybe that has to do with the move to fiat currencies or just the period where we live in. But the thought here is that deflation has generally been observed in our species due to technology, innovation, globalization, trade, human ingenuity. And the example I've got here is from a Yale economist who did some research on artificial light. So, we thousands of years ago, we had these candles made of beef fat, then we moved to whale fat, then kerosene lamps, then incandescent lights and LED bulbs. And from that, it's been a hugely deflationary force where not only do you get more light, but it's a higher quality of light. So his work suggested that, thousands of years ago, one day's work on average would get you 10 minutes of artificial light. So artificial light was a luxury good. Nowadays, one day of work might average you 20,000 hours of artificial light, and it's a higher quality light. And, the point I'm trying to make here is that there might be this deflationary backdrop behind everything. So, how do we account for this? It's hard to say. But, being from Actuaries, this resonates with me a little bit, because when I started in insurance, it would take me 6 months to 12 months to build a high quality production grade model. And now with Actuate, it's a bit of a plug, so forgive me, but it's much faster. So not only do you get a boost in predictive power, but you're creating models on the order of weeks. So that's why this example resonates with me, that we have to factor in some of the things that we're seeing, but maybe the long-term forces that are at play behind the scenes. So now we get to the strategies. The first one I want to talk about is improving estimates of future inflation. Now, you might have already done this. Like I mentioned, I would bring in those inflation trends here, but there's a lot of opportunity here, a lot of risk as well. And that will be a common theme throughout these strategies, that there's tends to be a trade-off. So I've got a few examples here, like using inflation indices and interest rates to maybe, see where the ball is going, or using historical trends to break out that inflation component in the trends. You could also use forward-looking inflation expectations. Now, this resonates with me a bit because, rate making is perspective. We're always looking forward. And maybe these folks have an incentive to predict the future better than me, and so they're doing it better, but there tends to be some inconsistencies with their predictions versus reality, to be blunt here. So something we need to be careful about, but we've already talked about some of these inflation measures that get used, and maybe there's an opportunity to use something that's a little bit more relevant. So if we can get just a slight edge on interest rates and inflation and build that into our process, maybe we're just a little bit ahead of our competition. And that leads pretty nicely into the second one. So utilizing scenario analysis. Now, for the younger folks on the call, you've grown up in a period of, great technological advancement where computing power is, very strong and you could do all sorts of things. But back in the day, it was not that easy. And so if you read like a textbook from 10 plus years ago, their scenario analysis is typically like these really simple decision trees where if this happens, we'll do that. If that happens, we'll do this. And then maybe you go a few depths in, and it was very simple. Now with tools like Actuaries, so again, sorry, a little plug here, but there are other options out there. You can build these really complex scenarios where maybe you're just making decisions of like, how will we change rates based on the indicated values? What happens if this version of inflation is correct? And you can build out a very complex statistical scenario analysis. And so it's kind of like moving from point estimates to a range of scenarios and explicitly acknowledging uncertainty. What I like about this is, again, I've got a bullet point here, it contextualizes decisions so you can measure them against possible outcomes, but also the ability to kind of have a playbook if something comes to fruition. So that is great, but it's not always that easy. And this next slide, I want to show, how there's some element of unpredictability. Now, if you're familiar with investing strategies, maybe you've heard of some of the macroeconomic views on investing. And one of the techniques that these folks like to do is looking at second order and third order effects. The idea here is that if electric vehicles are growing in popularity, maybe that's already baked into the price of the EV manufacturers, but maybe we go invest in lithium mines since that's an input. Or maybe it's even harder to invest in the businesses and communities around lithium mines. So if we can find a way to do that, we can get even more reward for the risk that we take. So that's the type of thinking, but this tends to be very hard to do. There have been some famous investors who have done this before, but I've got an example here from Jim Bianco of Bianco Research. I've adapted it a little bit to show why this is tricky. So Steve Jobs gets on the stage in 2007 and introduces the iPhone. It's a big leap forward from the Blackberries, and then eventually they open it up so there's an app market, and everyone's got this personal computer in their pocket that's connected to the internet, and it's very capable. Next, there's the 2000 financial crisis, and this creates the conditions for the gig economy to flourish. If you're not familiar with this term, gig is kind of like a short-term contract or like a one-time job that you can just pick up and put down. But you put those two things together, and the price of taxi medallions erodes pretty rapidly over the next few years. And that's because Uber has gone mainstream, presumably because of these things. So the point being, who could have predicted when Steve Jobs was on stage that the price of a taxi medallion was going to go down? I didn't see anyone go out and short taxi medallions, but maybe there was some genius that did this. I would have a disclaimer though. We have to be really careful with this type of thinking. We don't have counterfactual, so it's kind of hard to establish causality here. It seems reasonable to say that there's probably some connection that, things played out this way and, maybe Uber got lucky, maybe it didn't, maybe this was always in the cards. We don't know. So we have to be careful here, but it stands to reason there's some plausible, story that was played out this way. You're probably saying, what does this have to do with insurance? Well, let me give you an example. If you're familiar with tools, you've probably seen a reciprocating saw before. And this is just a tool that moves a blade back and forth pretty quickly, and it's not usually for like cutting wood; it's for like cutting metal. And back in the day, these were two-handed. They were really big and bulky, not very ergonomic. They eventually released one-handed ones, but they're still kind of bulky. It wasn't until 2018 or 2019 where they came out with the subcompact ones, and these are awesome. I have two of them myself. They're one-handed devices, but really ergonomic, really compact, very powerful. So those go mainstream around 2019. And then all of a sudden, the price of rhodium goes up during the pandemic. And it started slightly before that, but went parabolic. And next thing you know, catalytic converter thefts are skyrocketing. Presumably because someone found out, well, this fits pretty easily under a car. I can cut out the catalytic converter in 30 seconds, and it's got a lot of rhodium in it. And again, did these the conditions that were necessary? Would they have found another way to do it, even if the price of rhodium hadn't gone up, or had these subcompacts not come out? I'm not sure. Stands to reason that there could be some relationship here. But who could have predicted this? So I don't care how good you are at scenario analysis. I doubt you were building this in. And this was a particularly bad example because, we're familiar with demand surge in actuarial fields, but this was like a self-perpetuating demand surge. And it ultimately worked itself out to some degree. We still have catalytic converter thefts. The price of rhodium is still elevated, but not as bad as it was a year or so ago. So that leads us to our third strategy, and that's adjusting the product offering. Now, this is a really powerful tool, but one that comes with lots of considerations. And the thought here is that if maybe we can adjust the product to account for how things are changing and alleviate the pressure on price. There's also the added benefit that this can influence behavior and particularly reducing moral hazard. Someone's got a little more skin in the game. They might park their vehicle in the garage. They might put a plate under the vehicle so you can't take the catalytic converter. This strategy is, very relevant, but comes with some significant considerations. And the idea here is obviously this could impact customer satisfaction and retention. But more relevant in the United States of America is that we have departments of insurance who we have to, approve our filings and our changes. And there's potential legal consequences with that. Additionally, there's a heavy communication burden with brokers, agents, and policyholders to let them know that things have changed. So we got to be careful with this one. But in the United States, we still have some $100 deductibles, and virtually everything is more than $100 these days. So to some extent, that could how could you price that correctly? Maybe we need to remove those, and that's the idea here. We do have a question. Maybe I can. Oh, okay. So rubber snakes to discourage catalytic converter theft. That's a good idea, actually. So you don't necessarily have to buy a plate. You could just put a rubber snake down there. I like that. So going on to our next strategy. So utilizing a credibility-based approach. Okay, so most folks on this call would be familiar with credibility, but I'm proclaiming we're using it in a slightly different way. And for the folks that aren't familiar with credibility, the idea is that the mathematical technique for deciding how much trust do we apply to new data. Typically, it's because there's some noise and we're not sure if that's the right price, and it could create some instability if we're too responsive to new information. But this is using in a slightly different context where we know there's some inflationary trend, and maybe we want a data-driven way to systematically move towards where things are going, but have that mathematical component of stability. So, all else being equal, we should minimize the update to keep our prices stable over time. This is tricky again because if the combined ratio is over 100, might need to take as much rate as you need to, but definitely a tool in the toolkit that we're familiar with and just being applied in a different context. And most folks will be familiar with things like classical credibility, Buhlman credibility. But we recently gave a webinar and put out a white paper. This was the white paper I was talking about. That's very lengthy, but this was a multivariate analog to credibility. So it's using derivative lasso. And this is how you can incorporate that credibility component into your pricing models. So, a relevant technique, something that's familiar, just used in a slightly different way. Finally, we're at improving time to market. Now, okay, the industry has made strides about this. We're always talking about this. My claim would be that as much as we've moved forward, we're probably still behind on this. And again, we just talked about the combined ratio being above 100, and that's the case for a bunch of insurers and lines of businesses. But if inflation's at 4%, your combined ratio is at 100, and it's been that way for a year, probably in trouble. That doesn't sound sustainable. Especially if it takes you 6 months to 12 months to get rates in effect. That's kind of tricky to resolve. So the claim here would be that we need to find a way to be faster. There are other industries who can, change things on a whim. There's, potentially complications of this just with the nature of our business, but finding a way to be faster is important. What I would say though is that maybe we want the ability to be as fast as we want to, but the freedom to not be fast. And what I'm getting at here is that, if we know everyone's taking rate, there's a bit of a standoff here between competitors, where if we raise rates first, we might churn some folks to our competitors who hold off a bit. Now, this is always the case, and theoretically, we want people on the most actuarially sound rates right away. But we all know that there's a strategic element to that where, the fixed expense needs to be spread out over policyholders. So it's not just a purely theoretical perfect world. We do have to factor this in. Additionally, again, with the departments of insurance in the United States, if you're doing quarterly filings, just constantly updating things, it's not the best use of their resources. So I am definitely guilty of this. Early in my career for the states that I was managing, I was doing quarterly filings. And I wasn't really thinking through that, there's a human on the other side of this who has to make sure that this is regulatorily sound, and something that we have to factor in. Now, again, if the combined ratio is over 100, there's probably got to weigh your needs more than theirs, but there has to be a collaborative relationship here, and it's something we have to factor in. So again, bottom line, the freedom to move as fast as we want to, but the ability to not. Now, those are the strategies, but I want to get to the frequency component here. So we've got this clear relationship with the base rate. We've alluded to in some of these pricing segmentation, so the rating variables, very clear relationship to severity, but how does this relate to frequency? And admittedly, this one is a bit more nebulous. So I'm going to go in order of most nebulous to least nebulous, and hopefully, that will appease folks. You might not agree with the early ones, but the subsequent ones might relate more. Okay, so the first one, periods of inflation have been linked to social change and populism. This is well studied, and I don't know if we would say causal, right? Some link there, but that social change could potentially increase frequency. Now, this one I don't have a source for. This is just a theory I've had, and if I ever go get my PhD in economics, this would be my dissertation. But the thought is, did the inflation during the 1970s and all the social changes spark a rise in tort claims? So there's a very large rise in tort claims in parts of Europe, but especially in the United States. And it was just a whole bunch of frequency that came out of nowhere. And it's been so prevalent that we still talk about tort reform today. And the question is, again, did this cause that? Now, I don't have the research, I haven't done this, but the point I'm trying to make is that you could see some sort of connection where social change invokes a bunch of frequency, and maybe that's sparked by inflation. Now, if that's too nebulous for you, I've got a more tangible example. Several studies have linked periods of inflation to crime, specifically property crime. Now, again, is it causal? Maybe. This one seems a little more reasonable. But during periods of inflation, we might expect greater frequency for things like theft and vandalism. Now, the most tangible one I have is deferred maintenance, and I've got some pictures here to help illustrate this, but this is very easy to think through. If the price of everything around you is going up, maybe you have to postpone some of the maintenance, especially if the price of that maintenance is going up. So things like tires, replacing your tires. My wife just told me today, she was actually at the mechanic, and it was $600 to replace 2 tires. I was very shocked. We're not going to postpone that because we're fortunate that we don't need to, but if someone were to do this, there's a very clear link between worn tires and also worn brake pads in terms of propensity for risk. Very clear relationship. So this is one that would be very hard to pick up on, but we can assume this is out there. Additionally, I've got an example with brick walls, stone walls, where there's mortar between them, and it's the thing that's literally holding the building up. And if you postpone tuck pointing, and again, I'm not an expert on what tuck pointing is. I just know it's the maintenance for the mortar. This can be potentially bad for 2 reasons. One, the most obvious one is water intrusion. But if you don't stay up on this long enough, you could eventually get to the point where you can't even salvage the wall. You need to totally replace it. So the thought here is that, there is some component, potentially, not ready to say these are causal, but some potential with inflation to cause frequency. Now, I want to put all those together. So, if I were to anticipate some of the critiques from the more senior actuaries on the call, they'd say, okay, credibility, I'm always using credibility. The thing with frequency is cool. I think I've got an example, and it's a exaggerated one to some degree. It's synthetic, but where I bring all these strategies and the frequency component into play, and hopefully this is where we start to spark that intrigue. So think about a variable like age of dwelling. This is very prominent in property-related rating plans. And what we're getting at here is, how old is that structure? But this is a really weird variable when you start to peel back the layers. So it's certainly getting at the age of your home, that's obvious. But if you don't have some form of like when the structure was built, it's also picking up on the year your property was built in. And not exactly, but it is soaking up that signal to a degree. And the idea here is, if you've got a data set with maybe 10 years of data, there's a home that was 42 years old in the oldest year data, and also a home in the 42 years old in the most recent year data. They're kind of getting at the construction codes and the materials used in that decade. So not exactly a direct link, but it's definitely being picked up on that. But also survivorship. To make it to age 42, you presumably survived some incidents or also had a more desirable build that we didn't knock you down and replace you with something else. And if you don't have a renovation in your rating plan, it's also potentially picking up on that. It's unlikely someone renovates a 1-year-old home. I'm not going to say it's impossible, but you're more likely to see that in a 42-year-old home. Now, age of roof is in most rating plans these days, but that wasn't always the case. So back in the day, you could say that this was picking up on that component as well. Now, if we're thinking about inflation, we can already see how some of those components are tricky. We've got a lot of moving parts here that are just deceptively under the hood of this variable. Where I'm going with this is that imagine the relationship to construction type. So, typically we break things out into masonry or frame. Maybe you've got a more elaborate rating plan where you go into masonry veneer and stucco exterior. But I've seen a bunch of rating plans because they're generally public in the US. I've never seen anyone interact this with age of dwelling, and that's probably because there wasn't a meaningful relationship. So the factors for the construction type are possibly picking up on those differences, and the age of home is truly, the same within that dimension. But what if that were to start to change? So here I've got a synthetic example. I made this up, and hopefully, I haven't been to the future. I don't know the wages in 2028. But here's what this chart is showing. On the x-axis, we've got the year. On the y-axis, we have the median annual salary. And then I've got lines for a bunch of different professions. So 3 types of masons: brick mason, block mason, stone mason, and 3 types of carpenters: rough, finish, and framing. And the point I'm trying to show here is that what happens if just for some reason, the slope of the masons tends to start increasing? Maybe they're more in demand. Now, I think technically there's more of a carpenter shortage, especially here in the United States. So maybe in reality, this will go the other direction. But the point being that if you're using some sort of average measure of inflation, this would all average out. But what if your book of business tends to be more heavy with masonry? So here in the United States, we see a lot more brick buildings in the Northeast, the Northwest. And if you're prevalent there, this isn't going to average out for you in the right way. So what if you start to try and fit this interaction? And on the older data, say that you segmented this out. I've got the 2018 to 2023 on the left, and those factor curves look pretty similar. So there wasn't a meaningful interaction, and maybe that's the ports why we didn't have an interaction in the rating plan before that. But now on the right, we see that those older brick homes, maybe due to deferred maintenance or just the cost of masons is going up. It's a little bit exaggerated, right? But I don't think a whole lot of frequency is required to really blow up the cost of things on an aggregate basis. So, again, a synthetic example, but I'd like to think that this has all those components built in. So one point I would make is that GLMs don't assume time consistency. That's not an assumption in GLM. So, certainly it would undermine the GLM if you didn't break this out. I don't think it would be unreasonable to not break it out. But one assumption it would violate is that the residuals are independent of each other. So, certainly a reason to stay on top of this. And this is another little plug for Actuary, but this is why transparent AI is great. So we like transparent AI, not just because of the predictive power, but this is an insight that you get for free with building your models with something transparent. So with that, the 5 strategies staying ahead of inflation. I've got a little more material, but I want to revisit some of those objectives and see if we check them off. So review inflation and some of the complications associated with it. Check. I think we did that. Discuss strategies for actuaries to stay ahead of inflation and price volatility. And this is where that age of dwelling example. I think maybe we can step through this and see, improving estimates of future inflation. So it doesn't necessarily even need to be, future looking, but maybe we get more granular. And there are companies that sell that data of, mason wages versus carpenter wages. Is it worth the price? I'm not sure. But the point being that, if you can improve on that a little bit, maybe you can stay ahead of your competition. Utilizing scenario analysis. So it doesn't necessarily need to be, how much rate do we take? It doesn't need to be, different inflation assumptions. It could be, do we implement that interaction or do we not? Adjusting the product offering, right? Maybe this is even working with underwriting to say, we have to review the tuck pointing before we, sign you up, or maybe we make some sort of exclusion if it hasn't been maintained. This is a tricky one because, are we going to make people download an app to show us a picture of their tire treads? that's probably not worth it in the long run, but you could essentially see a way to build that age of dwelling component into this, utilizing a credibility approach. So, maybe this is a very bold claim. So we leverage credibility to systematically move towards where we think the ball is going, and improving time to market, right? So we have the freedom to update rates as quickly as we need to, subject to the regulatory component. But if this is truly a big change in the rating plan, we'd like to stay on top of that. And maybe we don't trust it as much in 2024, but around 2026, we say, okay, we got to stay on top of this. Can't wait 6 months anymore. We also had that frequency component, right? So, this one again, admittedly, is a bit more nebulous. But I think we've at least shown that the relativities between the rating variables would be clearly impacted by inflation. The base rate, very obviously, severity, very obviously, but maybe that frequency component too. And again, it doesn't take a whole lot of change to frequency to blow up the cost of insurance. And finally, spark intrigue. So I'll let you be, the decision maker of that. If I was able to, give you some ideas. But I've got a bonus strategy here. So I didn't write that white paper. And I thought it was good, very digestible. But here's one that I think I would have added. Now, again, this strategy has been perennially discussed in insurance, having a closer relationship with claims. This is always, I always hear insurers talking about this. And it doesn't always come to fruition because, insurance tends to be very siloed. The point I'm trying to make is that, we do a lot of things out of convention, regulation, or ease of business that might mask insights. So, just getting some ground floor input from the people that are on the phones with their policyholders to see, are there anything when you're filling out the claim forms that's different than it was a year ago that we could maybe look into? That would be great. But even something more ambitious here, and this is an example I've been thinking through. So I've got an example here. Whoop, I went a little too far. So, when we're building homeowners models, maybe we do an all peril model. The idea here is we know we lack homogeneity, but this is the best we can do. And as we start to get more data, maybe we get a little more granular and we say, weather and non-weather. That tends to be a logical way to break up these claims. The goal might be to get to something like this, where you get even further. So not necessarily, a subcomponent of weather, non-weather, but you can see I've kind of organized it where it is. And we're just getting more granular and more homogeneous. But what if we were to just totally reimagine this? And I'm talking specifically about that age of dwelling thing where, maybe the cost of masonry homes is getting picked up a little bit in each of these perils, but what if there was just a new way to organize this? So I've got here an example where we have like environmental, structural, and human induced. And you might see, the environmental trends emerging through some of those prior perils we talked about, but it would be a little bit more clearer here and those structural components as well. Now, again, this is very ambitious. I'm not suggesting that you hit up your claims team and say, hey, do a bunch of text mining and totally reorganize how you classify claims so we can look into this. I don't know if it would yield results. But this is just, again, something I've been thinking about and seems plausible that there's some sort of insight that, might get masked just due to the traditional way that we classify things. So with that, we're wrapping up here. I would like to say, thank you to the whole Actuary team, because this really is a team effort. Someone made a joke recently that, we got over 100 people that registered for this webinar. And they're like, Max, you're getting famous. I think they were joking because 100 people coming to a webinar does not equate to fame. But it did make me a little uncomfortable too, because it made me feel like maybe I'm getting a bit too much notoriety for this when I have a whole team behind me. So my sales teams, my marketing teams, they promote the heck out of these presentations. I've got a team of data scientists that help me with some of the technical topics. I've got a whole actuarial team that helped me review this and make sure it's relevant to insurance companies. So definitely thank you to the Actuary team. This is a great company. We're small but growing, and really appreciate all their effort behind this. Looking forward to our next thought leadership. So we're taking a short break from the webinars, but I've got a blog series coming up in August. Now, again, blog series might sound a little boring, but I would say this is going to be emphasizing on data for insurance companies. And so that in itself might sound boring, but I've been really privileged in my career to work on some more exotic and experimental things. And most people would agree that insurance companies are sitting on a gold mine of data. They just haven't figured out how to capitalize on it. So I have a bunch of views on this, and I say many more topics here than just listed, because it's really like 20, so we might have to prune those down. But I wanted to start with like the number of rows being a really misleading measure. So this is something that people always talk about. How much data do I have in terms of number of rows? And this is a really poor measure. But even just beyond that volume of pricing data you might look at, There's tons of options at your disposal, and things like unsupervised learning, synthetic data, potential of text mining, and some more exotic things for the future of data and insurance. So, again, we'll probably resume the webinars later on. We might roll this up into a webinar, a white paper, but I'd like to think that this will be worth your time. So with that, we do have a bit of time. If we have any Q&A, that'd be great. Shoot that in here. If we can't get to everything, I'll try to send a follow-up email where we address that. But if not, feel free to log off. And also, I would mention that not only will the recording be available, but if you want these slides to present in your own team, and you can be the hero, take all the credit for the slides, that's totally fine. Just shoot me a message on LinkedIn and we can send that over. I do have references for some of those studies that I mentioned in the slide notes as well, so that'll be available to you. So I'll wait for some questions. I don't see any coming in. So maybe that's good. Maybe we did spark some intrigue and get people interested in. Maybe some trade secrets are forming in your head already and you don't want to share those with everyone. That's cool too. So yeah, no questions. I think that's okay. Oh, we do have one. Oh, great webinar. Thank you. Heidi is actually my marketing manager in the United States. So I'm gonna be transparent about that, but definitely thank her for that. How much inflation is high inflation? Is it above normal or unpredictable? So, that's a great question. Now, in the United States, which I'm most familiar with, our Federal Reserve tends to target an inflation amount of 2%. The theory being that we want a little bit of inflation to incentivize people to not sit on their currency. And the theory is that it helps stimulate the economy. Whether that's true or not, I don't know. But from that definition, you might say more than the central bank's target. Now, again, this is debatable, and as we've already seen, there's tons of macroeconomic perspectives, but that might be more relevant to you. I would tell you from an insurance perspective, inflation is a hard thing to stay ahead of, right? Because if you have this underlying current where rates are just going up, that's a tricky thing to stay on top of. So we've been lucky in the prior decade where it wasn't too bad, but now staying afloat, I would think any inflation is too much. I know that's not going to be an exact answer. Let's see. With getting things into the market quickly being a high concern, might it be problematic to have such a generous definition of inflation as just an increase in price levels? Doesn't this imply far more variables into our equation to the point where it's extremely difficult to keep track of it? I think that's a really fair point. And this kind of goes back into that Kyle Bass quote of, the adjusted American measures versus the German measures. Adding too much complexity can make the model poorer. So I definitely think that's fair. I don't think that means we can't think through those things. We would like to have the ability to break them out, but very fair point. I definitely agree with that. Let's see, you got a bunch of questions coming in. Let me see. I believe there's a white paper from the CAS on social inflation. What is your take on this? And do you think it will continue to be a hot topic in the market? That's a great contribution. I actually did read that and I posted on LinkedIn when that came out. I totally forgot about that when I did this presentation. But yeah, I think that goes to the frequency component where, as society changes and we try to find a way to place the burden on whether it's the individual or the organizations, that paper was kind of getting at that the insurer is very susceptible to those changes. So, my opinion, again, this is purely my opinion, it doesn't reflect Actuaries, is that is a big risk for the insurance industry. It's really easy to say, insurance companies should cover all this stuff up until, again, we talk about those second order effects where it increases the price to the point where maybe we price some people out of insurance. And now we start to have this cycle that could potentially deteriorate the social benefit of inflation. So I think that's really relevant. We have to find a balance. In the US, we have these regulatory bodies who we can hopefully work with to find good answers that balance everyone's needs. But really great question. When reinsurance costs are an excessive percent of your direct premium due to large rising costs, how can one incorporate future expected increases into your rate filings? Admittedly, I don't have a whole lot of experience with reinsurance, but I know that this is a big phenomenon, particularly now. I'm not sure how you would do that. This is a tricky one because it also requires some negotiating power of like how long those contracts are, and the reinsurers tend to have a lot more of the power in those negotiations? That's a good question. Hopefully maybe this question has sparked some intrigue, Scott. So thank you for asking that. I don't know if I have a great answer for that. That's one that's tricky also, because if you were to anticipate too much, you might price yourself out of the market and then become uncompetitive. So definitely a tightrope act with that one. Let's see. How credible has data around age of roof data been? What do you think strategies can be for companies to obtain the most accurate data, especially something that could be very predictive? So, some of this is trade secrets with my former insurer, so I have to, my former employer, I have to be careful here. But I can tell you some of my experiences too, where when I purchased a home a few years ago, I updated the roof, and I knew as a policyholder I had to contact the insurance company and let them know. So I did do that, and then when I got my renewal letter, I noticed that it said age of roof, and it was the original age of the roof. They didn't update it. So right out the gate, they had that information. They didn't put it in. Potentially not good for me, but it was okay. We didn't have any claims. But I do think that there's some accuracy issues. Now, there are companies out there, I know some in America, that sell that type of data. I've not seen any sort of like ground truth to vet that, but I suspect there is some, element of inaccuracy there. The age of the roof is also kind of tricky, where like, in Southern California, where it never rains, maybe the age is on a different basis than in my home state of Delaware, where it's raining constantly. So age of home might not even be the best measure to get at what we're trying to get at. But yeah, definitely a great question. I think that's always the dance that we do in actuarial sciences. How much can we trust this data? How accurate is it? I think it's a step in the right direction, but certainly tricky. Few more questions. Do you do probabilistic modeling and accurate, such as Bayesian, Monte Carlo simulation? So our technique is this is a little bit beyond the scope of the webinar, but there's like degrees of Bayesianness. And I would say, just arbitrarily on a scale of 1 to 10, we're like an 8 out of 10 in the sense that, you can have a prior, your model pays a penalty to deviate from it. It's not the traditional Bayesian stuff that you might be doing in Stan, but there's definitely an element of Bayesian to it. The trick with the Bayesian stuff is that it's great because you have that explicit measure of uncertainty. You can build in a prior, but you trade off a little bit of interpretability. So we like to think our technique is the right balance of interpretability and Bayesianness. So I think the technical answer is no, but maybe a soft yes. So we've got a whole bunch of other questions. I might not be able to get to them because we're already at time. So we'll seek to export these and shoot out. Maybe we'll anonymize them, but shoot out some responses to the ones that we didn't get to. So thank you so much, everyone. Hopefully you enjoyed this. If you have any feedback for me as a presenter, that'd be greatly appreciated. I've only done 2 of these webinars now. I know I have a different presentation style than usual, so any feedback you give, greatly appreciated. And if you'd like us to move to more of those machine learning topics and away from the economic stuff too, that's great feedback. If you enjoyed this, we'll take that as well, and maybe we should start exploring things like this. Thanks so much, everyone.